Well, hello members, August 21st weekly review. Let's take a look at what happened, what we think may take place next. You know, if we look at these markets, they still haven't really done anything wrong. Yes, last week, just pretty much sideways, a little bump on the Russell. Now the Russell has the biggest gains for the year, but you know, overall, they're all sitting with pretty good gains at this point, so it's kind of hard to be negative, as you know, we've talked about for some time now. Let's go to the technical summary. You know, essentially the S&P 500 captured its target, and so if we look at the daily chart here, that's what we're talking about. The chart on the daily, the target has been reached, or actually got within like a point. So for all intents and purposes, right, essentially we have met that target. I don't get too crazy about, you know, getting an exact hit. You just needed one more point here on Monday. So for me, that's close enough, right? Government work, close enough. Now, what we talked about last week in the notes is that, you know, we're kind of forming now two ranges here. You got this one, and then you had the breakout range just above it. Tight little ranges here at these highs, kind of equidistant. No volume, summer months, slow trading, right? It's just grind higher and higher insofar that has worked. We do have these two swing point lows that we have to be considerate about because if we do start to turn, you know, those could become an issue for this market. And here on the Russell, you have the same thing, two swing point lows that we need to be cognizant of. If we look at the NASDAQ NDX, really nothing to say here other than the fact that this thing has just continued to claw higher. Got a little range up there as well. But at this point, you know, if the swing point lows are much lower, it's going to take a while before we even get another one at this higher level. It would have to be this one probably. So in other words, we would actually have to work higher for at least 6 bars so that that one could print. But we'll see if it gets printed or not. Either way, even if it gets printed up here, right, you don't have that same sort of location like you do on the S&P and on the Russell. In other words, these have all just been going higher and higher, not straight across. It's the straight across ones, the ones that line up, that can give you problems when the market turns on you. Going back to the notes here, dip buyers are the most dominant feature. That's been very true of all the indexes, in particular of the NASDAQ and the NDX. You know, almost every one of these, no matter where you look, almost every one of these bars on a daily time frame, almost none of them end up on the lows. There's one there, right? But even here, even these red bars here, right? You came off the lows by the end of the day. Just go back, look at all of them. You have almost zero, right? That's dip buyers just coming in every day, any little dip, and buying it. Now there'll be a point where that doesn't happen anymore, but that's the most dominant feature, has been, continues to be in these markets. We should probably start thinking about MTTFs. I know a member asked me a couple of weeks ago. It didn't make a lot of sense then. I was going to do it, didn't quite get around to it. But it's probably worth looking at now what these MTTFs are. So I'm going to pull over this trend cube, the trading cube. And what I want you to notice is what it looks like both on the short term and on the intermediate term. So if I'm looking here, right, you're getting up around 60. On the intermediate term, it's brand new, right? It's got a long way to go. Of course, on the long term, we've stretched so high for so long, and I really believe that this is really totally related to QE, you know, where they've made the second longest bull market in the history of the stock market, and it's all based on QE, in my opinion, or a large portion of it is based on QE. Ever since the August, I think it was 2010, when we started all this nonsense, you know, continual. You know, you would have thought 2 or 3 years into it you could have backed off the pedal, but no, we just kept pushing and pushing, and that's what's caused this. But anyway, let's look at this on the short-term time frame. 60% here on the NDX. If we look at the others, and I'm just going to flip through some of these. Here's the S&P. And on the S&P, let me get this out of the way so we can see them, 61 and 8. If we look on the NASDAQ, right, NASDAQ is 61.5. If we look at the Russell, right, and these are all the major indexes, 61, 64. Now, where does it become a problem? Well, if we go in here and I'll go to the trading cube, I'll just pull up the trading cube here off the tools so that we can actually get the numbers. And let's just take the S&P 500. I'll just take that one as an example and pull up the cube on it. And now that we have it, the 61.6, we can click on that and we can actually see what that projection looks like. And so if I pull it over, we're 31 bars into this move so far. So in other words, at this particular point in time, right, this trend where it transitioned to bullish happened 31 bars ago. And if we pull over the chart, you can actually see it right here. That was the transition as it got over that swing point high, went to bullish. 31 bars now. If you just look down the MTTFs, you can see the percentage, and this is cumulative probability of a failure. When it gets into the 70s and higher, 70 to 80 usually, right, into this range here, you could even count that bar, it's almost 70, all the way up until, 80% down in this area. This range is typically, if they last this long, they're going to push and push, and they're going to get kind of really overbought. And that's going to happen on anywhere from 37 to about 48 bars. Okay, so 37 to 48, we're on 31. That's 6 more bars. That's another week. Then we kind of enter into that period. So another 2.5 weeks is going to be a tough area to get over and continue up. Probably going to get some sort of a reset. So let's think about what it means to get a reset. If I bring back the S&P 500 chart, a reset doesn't mean that you have to break down, have a big correction, anything like that. A reset just means that you have to get under a swing point low. Now, if we were to do it right now, all I would have to do is trade back under this particular bar. And that price point in this particular case is 21.55. And we're sitting at 21.83. So if you get a close under 21.55 and you move down from here, we're only talking about, 28 points? Something like 28 points. That's really not that much. It's a couple of good days down. And you could actually get a quote-unquote trend transition. That would reset the MTTFs, and then you would have to get back over a swing point high in order to change that. And so if we just think about it, let's just say Monday we take off and head down, Tuesday we take off and head down, and we close down here and we break, well, I guess a little bit lower, right? We break this area. That would give us a sideways bar. That would be a sideways trend transition. And then if we just started back up again, what's going to happen? This particular bar here is going to register as a swing point high in that interim, right? And all we got to do is get just above that little bar, and all of a sudden we're back off to the races with a bullish trend transition again. And so the arrow would start back up again. So you can see that here a retrace that gives us kind of a refresh, right? And it could go lower. I mean, we could get all the way back into the swing point high potentially. In other words, we could come back into 21.18 or so. That still would be bullish. But all I'm saying is get a trend transition. You don't have to come this deep. You can come just to here and get it and then take off again. And that would fit well with this idea of, this resetting, this still being bullish longer term, right, and young in that trend. And so in other words, if we're looking at it here, and matter of fact, let me go back to this chart. Let me click on this. And then let's think about what it means to go to a trend, to go to a 70 percentile, on this particular chart. And so let me grab that, pull that over, right? We're on bar 7. To get to nosebleed here would be 40 bars. That's another 33 bars. These are weeklies. So another 33 weeks we're talking about more than half a year. We could be into February, March next year before this ever got to a nosebleed. We could actually make it to like April, May, right? Which is about the time they say May go away, right? We could get almost out to there before we ever got to a point where this was really, really stretched. And in fact, as we've talked about before, the ABCD structures are in effect here and point quite a bit higher. And so this thing could get some sort of a small reset, could just grind away for 8 more months before it ever reached the nosebleed. And so I just wanted to bring that up. I wanted to show you what it means in terms of these MTTFs and how it plays out. If you look at the sectors, they're much more mixed. It's just a lot of rotations that seem to be taking place there. You can look at those numbers yourself. And the qualified trends, if we go there, let me pull that up. If we go to the qualified trends here under resources market trends, if you come here, they're mostly all bullish. They're certainly all bullish here. They're all bullish on the long-term time frame. They're bullish on all the indexes, right? This is a very bullish picture, and that reflects the fact that we have a very strong bias to the upside with a lot of sector participation in terms of stocks. If we look at the qualified trends of the numbers of stocks, we're going to find that the majority of the stocks are bullish. Matter of fact, it's up around 65% right now. And that's a good, strong, healthy number. Markets don't crash when things are that bullish. Maybe they rotate around, maybe they get a pullback, but they don't crash. So we shouldn't be worried about a crash. We shouldn't be trying to position for a crash. What we should be doing is recognizing, that we could get a pause, we could get a reset. It could come at any point. But more than likely, it's going to get bought. No matter what it is, how deep it is, it's probably going to get bought. And so you shouldn't be afraid to walk into that when it happens. As a matter of fact, you should have some cash around in order to do that if, in fact, it takes place. All right, earnings. Earnings are over, right? And the weak quarter, according to FactSet, we had a weak one. This is a second quarter. It marks the first time the index has recorded 5 consecutive quarters of year-over-year decline since the Great Recession, 2008, 2009. So in other words, we have had the biggest earnings drought, if you will, negative earnings year-over-year, and that, quarter over quarter, year over year, and that is the first time we've done that since 2008, 2009 crash. But yet, where are we? We're at the highs, folks. I mean, these markets are at the highs. They're not down here, crash territory at 666, which is what it was back then. We're at 2174, 75, and we're trying to push to 2200. It's an odd case, but it is the way it is. The earnings, the expectation here, and you can read the rest of this, but the expectation is that these central bankers' actions are going to drive this market farther. People are trying to position for it. They've seen it enough times now to where they believe it. Now, one thing that does happen in the market is if you get everybody believing the same thing, eventually that's a problem. But that sentiment stuff, it's very hard to trade. It's very hard to say, okay, everybody's on the right side of the boat now. Now we can tip it over. It's just difficult to do. Longer term, you'll be right, but can you withstand the pain short term? If you're short term negative this market and been shorting this market, what are they doing? They're just bleeding you to death, right? All the way up, just grind. And so, even though the earnings drought is there, it hasn't reflected in price. We've simply gone sideways. We had this huge move up, all the way from 666 all the way up to 2100. Then we got a year and a half of sideways, some decent pullbacks, but never a breakdown, never broke a swing point low on the long-term time frame, never broke enough of them even on the sectors, right? We had like 3, I think, two of them actually. No, we had 3. We had energy, we had basic materials, and we had the IYT, the transports, all go to negative. We even had the IWM do that. But yet this market holds up, and earnings is not what's driving this market. It's the expectation of what the Fed's going to do. The other good thing, I guess, if you want to look at earnings, is that 95% of the companies reported at this point, 71% above the mean estimate. Sales actually above the mean estimate on more than half. This piece here hasn't happened in a while, but again, we're talking about estimates, and you know how the earnings analysts guide right to whatever the company tells them to anyway. So I don't know that I put a lot of stock in that. Positive technical picture, but the odds are shifting, some sort of retrace. I just showed you that with the MTTFs. The next, we don't have it technically yet. There's no breakdowns yet. We just have those swing point lows hanging out there, and we're not that far away, and we know that the MTTFs are getting stretched. Next week, we're going to get more data. We got PMI numbers around the world. We got a couple other numbers here domestically. And in particular, we got Jackson Hole and we got Yellen with a speech on Friday. All the central bankers gathered. We'll see if that affects this market. You know, we've had the dollar selling down, but the dollar, to me, I still long-term bullish there, in my opinion. Bottom line, technically no damage yet. The MTTF's doing what we just talked about. You know, what's the best case? I think the best case, you just break through 2200 and you just trade right on up to 2230. And so if you look at this, right, you bust through this 2200, and then you get a nice little push on some short covering up to 2220, 2230, somewhere up in there. And that just stretches this a little bit farther. What's the worst case? You know, this third attempt at a bullish retest regen fails. I think that would be the worst case. And what I'm talking about there is the probabilities do not favor this to hold the next time down. And we're not that far away, right? And so if we pull in here one more time, you know, the odds increase that we're going to get a reset. We're going to break one of these swing point lows at least, maybe both. I think that's the worst case scenario. And I think that's, you know, that has a possibility of happening. You have to be aware of that. What's the likely case? I think it's probably just continued choppy consolidation, this higher range. Got a little slight bias to the downside, I believe. Best shorter term trade, there was a couple this week that did breakouts. Let's take a look at those and see what they look like. The first one here is Hack. This is the cybersecurity, names like Palo Alto and so forth. You could actually go look at the individual names if you want, or you could just simply play the index. This is breaking out on multiple time frames. You see 3 swing point breaks here on the daily chart, and if you go to the weekly chart, you get the breakout there as well. Finally gets over the breakdown bar back here and gets over this swing point high. Now, anytime you're looking at these, you have to say, okay, is there overhead resistance right above? It's not going to allow us to go farther. Well, really, it's right up here. It's this bar. And so, you know, it's not a huge extension here. The breakdown bar above it was up in this area, and there's a swing point high just above that. So I think these are the 2 areas it could try to carry to. So there's a decent move potentially here. I haven't gone to look at the individual names, but that doesn't look too bad. And if we go to the monthly chart, of course, this is not a long-term ETF. If you go to it points up to that 31 area. So the bottom of this high, matter of fact, it's this overlap area here. So this to me, I believe, is probably going to be the target. It's right up in there. So 30, 31. You're sitting at 27. That's $3. That's another 10%. That's not a bad move on an ETF. Another name that I saw that kind of stood out was Kansas City Southern. If we pull up that chart, you see a breakout here. Now, this is kind of an interesting one, and this is something that you need to be aware of. You know, the TA Today tools, they keep track of all the swing point lows and highs, no matter where they were. The one that was broken here actually was from way back, right? It hasn't broken these 2 that it's faced with right now. There's one just slightly overhead at 99.20 and another one right there. And so we have 2 more swing point highs. We have a nice little dip, and you know, I just like this action where you get this nice push up, right? Then you're consolidating here for a good month and a half. You're getting ready to try to break this thing out. I like the way this is setting up. This is in the IYT, which is not particularly great because that's been kind of a tough spot. If you go to the weekly on it, and let's pull the weekly up. Let me grab that one. You can see also a breakout taking place here as well. And again, this is what is this, 99.07, and the swing point back here was 98.99, right? So you get over it and you break over it. So you've broken on multiple time frames. And if you look at this, right, there's really nothing up here. It's going over everything at this point. And I like that on a longer term basis, right, when you get that kind of a setup, where this thing's really breaking out. If I go to the monthly, right, the monthly actually has two bars that are kind of problematic. It's these two bars with the volume back here. It's right in this area. If it can get over that area, this thing can go back to the top. That's this breakdown bar. It's all in this area. So it's about, let's get a number on it. It's about 106, I believe. Yeah, 106. And then this one is 104.74. So about 105, 106. It's trading at 99. So if you get over that area, right, then you have the potential to go all the way back to the top. And so I kind of like the way this chart is setting up. And if you wanted to know, what actually was broken, if I put KSU in here on the trading cube, so if I just pop in here, go to the trading cube, put the symbol in, you can see it's in the IYT. It's bullish on this time frame, still bearish out here. So the IYT is, short term is doing okay and it's helping. This is not overbought yet. I like the way this sets up. But here's the point. You can go back and see what it broke. This was from September 17th, 2015 on the short-term time frame that it broke out. So that's the way those look. I think those are the best shorter and longer-term trades near time. Actually, I didn't talk about the long term. I think the equities, like I said, you just buy whatever dip comes along when it finally does. And when I say a dip, I'm talking about a retrace. Like we get 25, 30 points off the S&P. It's probably not a bad place to think about buying some. That's it for this week. Thanks for joining me, and I'll see you next time. Bye.